Welcome everybody! In this video we try to answer as simple as possible the question, what are stock buybacks? This video builds in part on a previous one, so if you haven't seen that one yet, watch the video titled What are stocks and why do they exist? In the last video we created a fictional company called AV Ltd that produces and sells shoes. We as AV went public and offered 50% of our company, divided into 50 million shares. This gave us enough money to develop and offer a new product line, specifically sportswear. And in this video we continue using this example. So let's imagine that our company shares are traded for a few more years on the stock market and our share price, which was $40 on our first day, has increased to $120, a 300% increase, which means anyone who had invested $10,000 in our shares on day one now has $30,000. So we've grown well, our new sportswear product line is selling equally as good, and AV has become a globally recognized brand. Now, however, we want to take another strategic step in our company's development. We want to sell headphones as part of our sports product line. Since we have no experience in this technological sector, we decide to directly take over and buy a headphone manufacturer, instead of building up all the necessary competences ourselves. We are convinced that we have to take this step in order to offer a new product with better margins. And because we as AV are absolutely convinced that this is the right step, and that our company and hence our stock price will increase in value once again as a result, we are considering a stock buyback. So what is a stock buyback? This means we are buying a part of our own shares back from the 50% we sold on the stock market in the last video. At the moment, as we said earlier, the stock is worth $120, but we are sure that this value will continue to go up, especially after we publicly announce that we are going to produce and sell headphones. We decide to buy back 10% of the available shares on the stock market. Just a reminder, we offer on the stock market only 50% of our company in 50 million shares, which means 10% of those 50 million shares are 5 million shares. However, those are not 10% of the whole company, but 10% of 50% of the company, which means by buying back 10% of the available shares on the stock market equals 5 million shares, we buy back 5% of the whole company. Let's calculate how much this buyback would cost. At the moment, the price of the stock is $120. If we buy back 10% of 50 million shares, which are 5 million shares, we can make a very easy calculation. 5 million shares times $120 equals 600 million. So to buy back 10% of the available shares or 5% of the whole company, it would cost us $600 million. Just out of curiosity, this means that our whole company at the moment is worth $12 billion. Usually, a company only does a stock buyback when it assumes that its own shares will continue to increase in value. This sends an extremely positive signal to the stock market and to the investors. Often, therefore, the value of the shares increases immediately after a buyback of a company, since everybody sees that the company believes in itself and in its future. If the company buys back its own share, they must be almost certain that the value will increase. So we buy back 5 million shares, 10% of our shares in the stock market for 600 million. The stock market reacts more or less immediately and the shares gain strongly in value because the investors believe in our company and in its additional development into the headphone sector. The stock rises to 200 within a few weeks after we made the stock buyback and announced the headphones. Now we calculate if the buyback made sense. The buyback of 5 million shares at a price of $120 cost 600 million. Now the stock, however, is worth $200. That means that our 5 million shares which were worth 600 million at the time of the buyback, are now 5 million shares times $200 worth 1 billion. An increase in value of 400 million, or more or less about 67%. Of course, to conclude this video, if the stock market and the investor did not believe in our future in the technological sector of headphones, the price of the stock could have dropped very drastically. In this case, we would have lost hundreds of millions of dollars. So, a stock buyback very often is an investment of the company in itself, and at the same time, it signals to the market that the company believes in itself. Thank you very much.